You called the direction perfectly. The stock ripped up 6% after earnings, and your call option somehow lost money. That is not bad luck, and it is not a broken broker. It is IV crush, and it is quietly the most expensive mistake retail options buyers make. Quick and important note before we go further. This is educational commentary, not personalized financial advice. I am walking through a mechanism, not telling you what to buy. Here is the core idea in one sentence. An options price has two engines, direction and the market's expectation of future movement. That second engine is implied volatility. When implied volatility falls, your option deflates even if the stock moves your way. Most beginners only watch the first engine. The pros watch both. Why does this matter right now in this market? Because we live in an earnings-driven, event-driven tape. Every quarter, thousands of retail traders buy weekly calls into earnings, into Fed days, into product launches. They are buying the single most inflated volatility of the entire quarter, and they do not know it. The setup practically manufactures losers. Let me define implied volatility cleanly, because vague definitions are why people lose money. Implied volatility is the market's forecast of how much a stock will move, backed out of the option's current price. High IV means options are expensive because a big move is expected. It is a forecast, not a fact, and forecasts get repriced the instant the uncertainty resolves. Now the mechanism. Before an earnings report, uncertainty is maximum. Nobody knows the number, so implied volatility spikes. Option sellers demand a fat premium to take that risk. You, the buyer, pay that fat premium. Then the report drops. The uncertainty is gone in a single second. IV collapses, sometimes from 90% to 40% overnight. That collapse is IV crush, and it comes straight out of your option's value. Here is a concrete example with round numbers so the math is obvious. Say a stock trades at $100 the day before earnings. A weekly at-the-money call costs $5 and implied volatility is 80%. The options market is pricing an expected move of about 8%. Earnings come out. The stock jumps to 104, up 4%. You were right. But the move was smaller than the 8% the market paid for, and IV crashes to 40%. Your call, which should have gained on the $4 move, is now worth maybe $3.50. You were correct on direction, and you still lost 30%. Sit with that. The stock did what you said it would. The problem was never your thesis. The problem was that you needed the stock to beat the expected move, not just move in your favor. Buying options into an event means you are not betting on direction. You are betting the actual move is bigger than the priced-in move. Those are completely different bets, and almost nobody makes that distinction before clicking buy. There is a second, quieter killer here, theta, or time decay, accelerating right alongside the crush. Short-dated options lose value fastest in their final days, so the weekly call you bought is bleeding from two wounds at once. Volatility deflates the balloon, and time decay lets the air out even faster. Retail traders love weeklies because they are cheap and they move fast. That same leverage is exactly what destroys them when the move underwhelms. How do you actually see this coming instead of getting ambushed? Look at the expected move before you trade. You can approximate it. Take the price of the at-the-money call plus the at-the-money put for the nearest expiration after the event, and that straddle price is roughly what the market expects the stock to move, up or down. If a stock is priced to move 8% and you only think it moves 3%, buying calls is a losing trade even if you are right on direction. That single check would save more accounts than any indicator. Also watch IV rank or IV percentile, which tell you where current implied volatility sits versus its own history over the past year. If IV rank is near 100, options are historically expensive and you are the one overpaying. If IV rank is low, options are relatively cheap. Buyers want low IV. Sellers want high IV. When you buy calls into earnings, you are buying at the single highest IV rank of the cycle and hoping for a miracle-sized move. So what does a disciplined trader actually do? First, they separate the two bets. If they only have a directional view and no strong view on the size of the move, they avoid buying inflated event premium entirely. They might trade the underlying or use longer-dated options where IV crush is a smaller fraction of the price, or simply wait until after the event when volatility has normalized. Trading the day after earnings, when IV is crushed, is often a cleaner directional trade than the gamble before it. Second, if a disciplined trader has a genuine view that a move will be larger than what is priced in, they express it deliberately, sizing the position as a small, defined risk piece of the account, knowing most of these bets expire worthless. And third, when they want a profit from the crush itself, They consider being a net seller of that inflated premium through defined risk structures, so that collapsing IV works for them instead of against them. That is a process, not a recommendation. The point is intention. Zoom out and the lesson generalizes far beyond earnings. Anytime the whole crowd knows a catalyst is coming, the crowd has already paid for it. The Fed decision, the jobs report, the product launch, the court ruling. Volatility inflates into the known event and deflates the moment it passes. Your edge is never in seeing the obvious catalyst. It is in judging whether the market has priced it correctly. Right on direction, wrong on price paid is still a loss. So next time a call goes red on a green day, do not blame the market. Pull up the expected move and the IV rank and ask whether you were betting on direction or secretly betting on size. That one habit separates traders who survive from the ones who keep funding everyone else's premium. If breakdowns of the actual mechanics behind the market are useful to you, subscribe so the next one finds you. Trade the math, not the hype.